Hello everyone, welcome back to Upside Down Data. Today I want to talk about the correction that we saw across the crypto market in the last 24 hours or so, and some indicators and factors that we can look at to think about where the market might be heading next. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter, where we put out regular updates about our risk indicators and more. So if you're like me and you woke up, it wasn't a super nice thing to look at the markets and where they stood. Bitcoin had been doing relatively well earlier on in the day yesterday, and then suddenly we had a pretty sizable correction that drove the rest of the crypto market down with it. And Bitcoin currently is sitting below 40K. And that was a level that had been talked about a lot by a lot of people as being a kind of critical level that we had to hold. Now, it's unclear as of now if Bitcoin will be able to reclaim 40K and we'll be able to kind of reverse. We'll talk about that in a minute, or where we're going next. So I really want to talk about what can we look at to get an idea of where we stand in the market today. So, of course, with this channel, we talk a lot about our risk indicator, the upside downside potential indicator. So that's where I figured I'd start to see what it is saying. So what I'm showing you here is the long-term version of our upside downside potential indicator. So this cares about moves that play out over months to years, kind of these broader market cycle moves. That's what it really is trying to pick up on, points of low and high risk within those broader points. So I'm showing you here the price history of Bitcoin across time, color-coded to that risk indicator. So 5, these dark red times being high risk, -5, being low risk in Bitcoin's price history. And you can see the UDPI does a pretty good job of identifying these high and low risk points throughout Bitcoin's price history. And what you'll notice, and we've been talking about for a while, is that Bitcoin has dipped back down into the green. We're actually down in this kind of level here, we're actually approaching -3 now on the long-term UDPI. And so when we kind of get down to these sort of levels, historically speaking, this has been these kind of accumulation zones that have been advantageous. But it is useful to note, in my opinion, that the price appreciation that can be expected off of these points isn't necessarily instantaneous. And that's kind of with this long-term perspective in mind. The idea that even if you're buying in these periods, you might have to wait a considerable amount of time before you do end up seeing profits. But the idea is that given enough time, historically speaking, buying in at these green zones has seen significant profit over time. Buying in even during this stretch here in 2018, though more downside eventually did happen, and we got down to these super low risk levels there, ultimately, if you had held any Bitcoin you had bought there, you would have done quite well into the future. And so this is just a useful indicator to get an idea of how risky is it in the long term. And again, it's all about setting your time horizons appropriately. Even though that's in the green zone again, does not mean we have to go reclaim have to go and reclaim all-time highs anytime, especially soon. We could see something like the summer where it was only a few months before we're putting in, big moves to the upside, but it could be a lot longer like we've seen in the past. And it really depends if we're about to go into a protracted bear market like we've seen in the past, or if we're going to do something more like the summer where we quickly reverse. We'll talk a little bit more later about which ones kind of how realistic each of those possibilities are. That's just something that's important to keep in mind. That historically speaking, given a long enough time preference, these zones have been quite advantageous. But again, the important factor there is with the correct time preferences and assuming that, Bitcoin will continue doing what it's been doing in the past with its pretty explosive growth to the upside over time. So that's one thing to consider. And so from the upside downside potential indicators perspective, right now is not an especially risky time for Bitcoin. So even though more downside potential is realistic, it still thinks that given enough time, it's going to look, in retrospect, like some of these times we've seen in the past, where, looking back in hindsight, anyone would dream to be buying Bitcoin at these low levels back here, knowing what it did later. From the model's perspective, it thinks that, in hindsight, this point could look similar to these in the past, given enough time, with enough time horizon on there. So that's just one perspective. Let's look at another perspective given by another indicator that we like to look at on this channel, and that is the momentum bias indicator for Bitcoin. So this is different than the UDPI. So this is not a risk model per se, although it does tend to signal tops in the market as well as bottoms. Really what this indicator is geared to do is to measure the amount of momentum in the market, and if it seems to be biased towards the upside or biased towards the downside. And what I mean by biased is just kind of a predominance in the market for upside momentum versus a predominance in the market for downside momentum. And essentially the way that it kind of works is that during bear markets, during these bearish phases, you'll see the momentum bias indicator hang out below zero for quite a while. The way the momentum bias is scored is this is a z-score, and what that means is that 0 is the average. So this is the average kind of momentum bias for Bitcoin, and because Bitcoin has been going up over time, 0 is actually kind of a positive bias. And then anything above 0, these are denoted in standard deviations, which is a measurement of variability. And essentially the idea is that as you get above 0, you're getting to a positive momentum bias beyond what's kind of typical for Bitcoin. And that's where you get to these really big bubbles that we see that break into these big corrections, where once momentum has kind of gotten so biased to the upside, so far above and beyond where Bitcoin tends to be in its positive momentum, that it can't be sustained and it ends up crashing. We've seen that over time. Usually once you get above 1, that tends to indicate these topping out points for Bitcoin. Whereas conversely in the negatives, as we get to negative half a standard deviation and negative 1 standard deviation, this is Bitcoin showing negative momentum, and especially lower momentum bias than it typically does. And so you'll see in these bear market phases that the MBI will hang out in these negative zones a lot more frequently and for a lot longer. And essentially what that's saying is just that there's a predominance of negative momentum that's dragging the market down, and then slowly the market has to reclaim a more positive average momentum bias for it to start to be able to move back to the upside. And so what you'll see is that in these bearish phases, the MBI will hang out below 0 for quite a while, and then we'll slowly start to reclaim 0, and there tends to be this kind of equal oscillation around 0 that happens as we're rising into the next bull market, and then we start hanging out a lot in the positive area until we have those big blow-off top points. We even saw this here going into the winter and spring of 2021 here, where we were kind of had the COVID crash here, oscillating around 0 here, and then shot up into the positive territory, hung out there for quite a while before we had to crash all the way back down to the negatives. We had started to kind of do this oscillation around 0 again, coming out of the summer. And now what we're really looking at with the MBI is what does it do next? Because I think this will be quite diagnostic. So we've kind of seen this equal oscillation so far, coming out of the summer into September and then into November, coming up all the way to positive 0.5 in November. And then we come down to negative 0.5 back in later of last year, the later months of last year, November, later November and especially December. And now what we're trying to see is just what is the MBI going to do? We see it's just kind of hanging out here around negative 0.5. And one thing that's a little bit concerning is how long we've been spending down here. We're not really getting this equal oscillation yet around 0. In fact, we seem to be spending more time in the negatives, which is not really ideal. And especially what I would be concerned about is if we break down lower, if we really kind of decisively break below negative 0.5, especially if we start revisiting some of these lower levels that we've seen in the past that have signified the beginnings of these more protracted downtrends, or just big capitulations, if we stay down there for a long time. And it's also what I'd be concerned to see is if we do come back up, but then we get rejected off of 0. If we're trying to reestablish a positive momentum bias, but then we're unable to do so. If we get rejected off of 0 and have to come down, because that's what we've seen in prior bear markets, where every time we try to reclaim 0, we just get rejected and have to come right back down. We'll have to wait and see. One thing that is possible, though, is that if we do see a major capitulation like we saw in the COVID crash, or like we saw at the bottom of the bear market in 2018, that might be such a kind of flushing out event where it kind of really flushes out both leverage and just kind of, weak hands, people who aren't really here with any conviction, just kind of shakes out so many market participants that really the only path left is up, that the path of least resistance then is up from there, because no one is left to sell. Anyone who is going to sell is already sold, so there's really nowhere for it to go but up. Now, of course, if that were to happen, it would probably mean the price would have to fall pretty precipitously from where it is currently for that to happen, but that might mark kind of a bottom point. If we do see one of these major capitulations down to one of these zones, that have tended to indicate a bottoming out point in the past. So something just to keep an eye on, that when momentum bias gets so extreme to the negative, oftentimes that will signal a point at which the buyers have been exhausted and we can reverse. So it would be short-term pain for that to happen. I'd expect price that to fall pretty considerably for us to get down there. But if it were to happen, it might mean that the bottom is more definitively in, that we can be relatively confident that the downside is over, and that it might be more likely for us to start trending back up in our momentum bias and then eventually be able to reclaim a positive overall sustained momentum bias. So something to watch. I think right now we're still a little bit uncertain. It's going to be interesting to see. But certainly if we have a big break to the downside, or if we're to come up and get rejected off of zero, that'd be quite informative, because I think coming up and getting rejected off of zero would mean that there might be a more protracted bear market coming. A big flush out and capitulation might actually mean the bottom's in. So kind of depending on your time frame, you know, some people might actually prefer for us to just get it over with, dump down, and then be able to start moving back up again. But we'll have to wait and see. You know, obviously no one really wants that to happen because it's quite painful in the short term when it's happening. We'll just have to wait and see what happens. So where I want to move the conversation to next then is to talk about the stock market, because one of the things we've been observing with Bitcoin in the past few months is its increased correlation with what the stock market's doing. It seems like when the stock market has a good day, Bitcoin has a good day. When the stock market has a bad day, Bitcoin tends to have a bad day as well. And so really what I want to talk about now is what has the stock market been doing, and what role might that have been playing in this recent price action we've been seeing. So first, just to take a macro perspective on the stock market, what I'm showing you here is the price history of the S&P 500 on the monthly time frame, all the way back from the early 40s, all the way up through present day, up to the modern day. And what we can see is that this is the risk indicator. This is the upside downside potential indicator for the S&P 500. And what we can see is that we've re-entered this red zone. And we've seen this in the past. I've talked about this in previous videos, where two different things are possible where we stand right now. We could do something like we did back in the 50s and 60s, where we kind of just do these rabbit hills, where every time we kind of get a little bit into the red zone, we have a correction. Red zone, correction. You know, red zone, then we have a correction. Or we could do something like we saw in kind of the dot-com, you know, the tech bubble that we saw in the huge rally that happened in the 90s going into the early 2000s, where we were in the red zone for a long time, for years and years and years, before it ultimately burst and had a massive correction off of it. So we haven't been running that long in the red yet. So if this happens, we still have a decent amount of runway before we see a big correction. But it's also very plausible we'll see something like this play out. And if something like this happens, you know, given how correlated Bitcoin has become with the stock market, it's totally reasonable to think that Bitcoin has more downside to realize if we end up doing something like this in the short term. And there's certainly a lot of people that you're seeing who are calling for this kind of action, seeing a pretty sizable correction in the S&P 500 price soon. Now, who knows if that's going to happen? You know, predicting the stock market is more or less impossible to really know exactly what's going to happen, but it's something to keep an eye on. And it's one of the kind of risk factors that I see for the crypto markets, that it's the unfortunate reality that the crypto market cares a lot about the broader macro conditions. And so if equities see a massive sell-off, I would expect crypto to be hurt as well. I don't expect them to be insulated. But again, what that might just mean is that, you know, given the long enough time horizon, that could just be opportunity. It could allow people to enter the crypto market at substantially lower valuations than we've seen for a while. And then, you know, with conviction that the crypto market is just going to keep on growing with time, that might be kind of a once in a lifetime almost opportunity to get in at a lower level. Now again, none of this is financial advice or anything about how you should plan or what you should expect from the market, but just something to keep in mind, that when you zoom out, it kind of changes your perspective on these market crashes to some degree. So what I want to do now is switch over to just looking at some additional factors. So I'm actually going to talk first about continue talking about the stock market, then I want to switch back to the Bitcoin price chart, and then wrap up with some derivatives data that is interesting to look at. So what I'm showing you here is the daily chart for the S&P 500. So we were just looking at the monthly time frame with our risk indicator. I just want to look at a little bit more zoomed in time frame to see what's been going on. So one thing that's been very interesting over the past few days with the S&P 500 is that we've been really seeing a breakdowns through some kind of key moving averages. So one thing that you'll notice is that ever since kind of the rally that got started at the bottom of the 2020 crash, essentially, is that the 50-day moving average here in blue had offered a pretty reliable level of support for the S&P 500 ever since. You know, we'd break down every so often, but we quickly reclaim it and then just keep going. And that had been going on for quite a while, you know, ever since, you know, arguably back maybe in June of 2020 when we kind of first tested it as support, it had been offering that support level. And then recently we've been testing it a lot more frequently ever since September, and now we've seen a pretty big breakdown below it in the past just several days. You know, from above it back on the 13th of January to now where we stand on the 21st, being well below. And in fact, we've also broken below the 100-day moving average, which should also come in to offer some support a few times. We've broken below that pretty decisively, and now we're actually testing the 200-day moving average, which really hasn't been important since June of 2020. We've been so far above it, it hasn't really come into play except before here. So really, we haven't actually broken below the 200-day moving average. Really, the last time we moved below it before reclaiming it was actually for the COVID crash, the March 2020 crash. So this is something that we can see is actually a pretty potentially important level, at least a kind of an important line in the sand, or kind of determining factor of whether or not a more bullish or bearish outlook is reasonable. So far, the S&P 500 has not broken below that, so we can say that at least as long as we stay above it, maybe that's going to allow us for some support that allows us to continue ultimately moving back to the upside. But it's certainly worrying that we've been breaking below these long-standing moving averages that have been offering support, and we're now moving down to these kind of longer time frame moving averages as support here. So something to watch closely, in my opinion, to see what the S&P 500 does as it interacts with this level. If it's able to bounce off here, that'd be good, and I'd expect the crypto market to also catch a bounce then, if the broader equities markets do well. But if we see a big breakdown below this level, I would see that as quite bearish, and it could see some short-term selling pressure. Because, you know, other traders are going to be looking at these levels, and, you know, the 200-day moving average is often treated as a pretty important level. If people see breakdowns below that, that can kind of lead to a self-fulfilling prophecy where people say, oh no, now everything's bearish, better get out now before it keeps going down. Now, that's not the guarantee that would happen. It could be that we break below the 200-day moving average and then just go right back up. Anything can happen in the market. But just given that the importance that a lot of people place on this, it could mean some short-term downside to be seen if we do decisively break below it in the equities market. And maybe a little bit more concerning on that front is looking at the NASDAQ, which is just a different index to kind of track the overall stock market, a lot more tech-heavy of an index. And here we actually have broken below the 200-day moving average. Yesterday we did, and then today we've been trading below that level. And some people have been noting that Bitcoin has been actually correlating even more heavily potentially with the NASDAQ than with something like the S&P 500. So this might be concerning. And we've been seeing this kind of play out where a lot of the really high growth stocks that have been doing incredibly well coming out of the March 2020 crash have now seen massive drawdowns from their all-time highs on their stock prices. A lot of kind of stocks that have been really blowing things out of the water during this kind of big run from March 2020 have now been getting hit quite hard. And so that is showing up here in the NASDAQ. So something to keep an eye on. You know, ideally we'd like to see the NASDAQ reclaim the 200-day moving average at the very least, if not be able to eventually rally back above some of these other key moving averages for us to feel especially bullish on Bitcoin in the more short term. As it stands now, Bitcoin would really have to start uncorrelating itself from the equities market to be able to put in convincing upside while the equities market's doing not so well, while we're in this correction. And so one thing to be watching is where equities end up bottoming out. You know, there are a lot of bears out there saying that we're going to be seeing a massive correction from here. You know, there are people who are calling for a 50% correction or more in equities markets. Who knows if that's realistic, if that's going to happen. Certainly what we're just looking at with our risk indicator in the S&P 500, it wouldn't be historically unprecedented to see that kind of a downturn from these risk levels, but it's not guaranteed by any means either. So I think one of the unfortunate realities that we stand in the crypto markets is we have to watch these levels. You know, as more and more institutional investors have been getting in, you know, they care a lot about this macro perspective. You know, it's not really being driven by retail anymore. And so to the extent that they're kind of trading on this broader perspective, it's important for just to keep an eye on what's going on here to get an idea of what might be happening for Bitcoin. So just something to keep an eye on. So, you know, I'm not trying to be doom and gloom. This is not, you know, we're not doomed by any means, I don't think, right here. But I really would like to see the NASDAQ reclaim the 200-day moving average soon to be able to start feeling a little bit more confident about any kind of rally in the crypto markets being sustainable. So to switch back over to Bitcoin, what I want to look at here is just what's been going on. So I have a couple of different levels laid out here. So around 30K, around 40K. And as we've now broken down below 40K, there's some different possibilities I think that could be happening. So the one possibility, which I don't think anyone wants, but it's something that we have to consider as a possibility, is that we've re-entered this kind of 40K to 30K range that we were in the summer, and that maybe we're just going to end up ranging down here for a while, that we're going to ultimately end up retesting 30K before maybe we can find support and move back to the upside. And certainly if we still continue to see sell-offs in the equities market, that unfortunately, in my opinion, becomes a more realistic possibility that we'd end up breaking down some of those levels. Hopefully 30K would provide support in that scenario and we wouldn't have to go further, but that would be kind of a bearish outlook, that if, given all the uncertainty in the broader kind of macro environment for assets, we can't rule out that as a possibility. Now, the more bullish possibility would be that, if we get some bounces in the stock market to set things up, then one thing that could also play out is a pattern sort of like what we saw in the summer. And technically this pattern could play out regardless of the stock market. Anything's possible, but I think this would be more likely if the stock market shows a little bit more healthy action. Where you'll notice we had this, what a lot of people had called kind of this Wyckoff accumulation pattern we saw in the summer, where we kind of had this big capitulation, deleveraging event here, where a lot of people got liquidated in the derivatives market. And then we kind of traded sideways, had this fake out move to the upside, came back down, and then came back down one final time before being able to move back to the upside. And so if you look at what we saw kind of starting in early December 21, you can, if you squint, you can kind of see a sort of similar pattern playing out here. We had this liquidation wick, came back up, had this bit of a fake out around Christmas, and then we had the second move to the downside, maybe like this, came back up. And so maybe it's just a more shrunken and kind of more aggressive move than what we saw in the summer. But if that were to play out again, this could be the bottom point from that kind of pattern. Now, again, I want to be cautious in how much weight we put on this because, again, to think that history is going to exactly replay out again, or these patterns are going to replay out kind of the same way they did in the past, is always a little bit questionable. And so what I want to say is just that this is a possibility. So if we're to see a strong rally coming out of it, it could be that we're just going to do this again. That's totally possible. But again, from my perspective, I would find that kind of a move a lot more convincing if we see more healthy action happening across the crypto space, or excuse me, the equities market as well. If the SP 500 and the NASDAQ can kind of stabilize, stop correcting, at the very least move sideways, or potentially, or more ideally, move back to the upside, I would see a move like that as being a lot more plausible and sustainable. Because again, the unfortunate reality is that we have traders who aren't just caring about the crypto markets, they're caring about the broader markets as well. And with crypto being seen as a risk-on asset, if the rest of the market is risk-off, it seems unlikely that those participants would make a carve-out for crypto when they're not making a carve-out for the other markets. Not to say that's impossible, but it just seems a little bit unlikely. So that's something that I'm watching. Those are kind of the two scenarios that I'm kind of looking at. That, in my opinion, the two most likely things for us to see is that in the bearish case, us kind of coming back down into this range we saw in the summer. And then absolute worst case scenario, maybe we have to end up going down and retesting the 200 week moving average, which now sits at 19K. But I still, where I'm standing now, see that as a pretty unlikely thing, at least in any kind of short term. I would expect to have at least some kind of relief rally before that would be necessary, just because our risk is so low already that I just really think it's unlikely that we dump immediately back down to 19K. I think that's pretty unlikely. I think kind of the more realistic bearish scenario is that we grind down into the 30K range and then see some moves back to the upside. And maybe that would give us enough time that the broader equities markets figure out what they want to do, are able to sort out their corrections that they're going to do, and then we can coincide to go back to the upside. It really just depends on a lot of factors. It depends on what the Fed does. It depends on if interest rates really do get hiked, or if they get hiked as much as the Fed is saying they might do. If the Fed really does start to do what they call, I believe, their balance sheet normalization, where they're actually going to potentially sell things they hold in their balance sheet off into the open market, which could then suck liquidity out of the markets. It just depends what they end up doing, which will set the broader backdrop for what Bitcoin might be realistically expected to be able to do in kind of the more macro sense. And so I think everyone needs to be prepared for whatever could be coming next. We need to be prepared for if we end up seeing moves back down to the 30K level, but we should also be prepared for the possibility of a move like we saw coming out of the summer. So I think either is possible. We'll really just have to wait and see what happens over the next few weeks to see which one seems to be likely. I think especially if we start having a lot of daily closes below 40K, moving down to 30K becomes a lot more likely. I'd really like to see a relatively convincing reclaiming of 40K to be more bullish in the short term. But that's just my perspective. You know, you can feel free to disagree, have a different outlook. This is just what I'm looking at in the market. And the final thing that I want to close off with here is just to talk about a little bit about derivatives data. Because one of the things that's kind of unfortunate with crypto right now is that we're in a bit of a low spot demand environment. You know, retail is out. Retail hasn't really come back since the spring. And what that means is that derivatives play kind of an outsized role in the price action. That a lot of these moves we see are driven by what people are doing in the derivatives markets, and liquidations either on the long side, so people who are betting long, but then the price moves too far down, they get liquidated and price dumps along with it, or short squeezes, which is actually what we saw in the summer, where so many people were short that price started moving up, and then it liquidated their positions, and we saw these big rallies that we ended up going on to. So I'm showing you here Binance and what's going on with their open interest. And the reason I'm looking at Binance partly is that if you look at the overall open interest in crypto, most of it actually sits on Binance. So it can be informative to see what is going on in Binance in their derivatives trading. And the one thing I think is, there are a couple things I think are informative just by looking at this. So this is the overall open interest over the last month. And what you can see is that, if anything, the Bitcoin valuation, which is these yellow bars here, has actually been moving up. Now you'll notice that this black line here, this is the USDT, the dollar value of the open interest over time. Now this is going to be susceptible to the price of Bitcoin, obviously. So oftentimes people care less about that than what the Bitcoin open interest is, which is what these yellow lines are. So I would say ignore this black line. I don't think it's as meaningful as what the yellow bars are showing. And if we just look at the yellow bars, we can see that's actually kind of elevated since what we saw in late December. If it's going in any direction, it's slightly up. And that is obviously not great in some senses, because when we have really high buildup of open interest, that's when these liquidation cascades are possible, like we saw in early December. But the other thing that's important to keep in mind is, where are the positions? Are people mostly short, where they're predicting the market to go down, and so they get liquidated if the price goes up? Or are they mostly long, where it would be the opposite? They're predicting things to go up, liquidated if price goes down. And what we can see is, at least on Binance, is unfortunately, what I would like to see right now is a more of a bias starting to emerge to the short side, or at least the trend being opening of more positions of the short than the long side. Because when you have an abundance of short positions, that's when those short squeezes can happen that can really lead to these explosive moves, at least in the more short term. But at least on Binance, on their kind of long to short ratio, we're not really seeing that. Now, one thing that's a caveat for this index here is that this is just counting the number of positions. It's not taking into account how large each of these positions is. So it's a bit of a rough measure. So if you assume that each position is roughly the same amount that's being put up as collateral, then or the size of the position is about the same, that's one thing. But I think that's a little bit questionable to make that assumption. So take this with a grain of salt. This might not mean that it's as imbalanced as it shows here, but one thing that it is showing is that we're still showing this bias to the long side, which might possibly suggest that as we keep seeing price falling, people aren't really believing it yet. They still just are trying to buy the dip, kind of, leverage up to try to catch the bounce to the upside to make, kind of high returns, leverage themselves up heavily to make bigger returns on that bounce. But the problem is that over the last month, we just haven't really been getting those convincing bounces. We have a small one going into Christmas, but it really wasn't that great. And we just haven't seen any really convincing rally off of this. And so, again, this is just one data point looking at what's going on in Binance. This is not representative of the entire derivatives market. But it would just be nice overall to see a bias towards the short side, because that would allow us to have a better setup with what we saw back here in July, where there was a much heavier bias towards the short side that allowed us to have this huge short squeeze to the upside. And that might be one data point against this playing out exactly the same here, where the conditions just aren't really quite the same as the summer. And also we have to remember that during the summer, stock market was doing quite well. Look at this. The stock market in June, July was above the 50-day and never really decisively broke below. Things were bullish still in the broader markets. Right now, they're not. So keep that in mind. You know, if you're betting the farm on this happening again, I would just say maybe be a little bit cautious. So not financial advice, you know, you make your own decisions. But in my opinion, I think it's time to be a little bit cautious to just expect this exact same thing to happen again. It certainly could, but it's not guaranteed by any means. And I would really like to see equities markets showing more strength before I get more confident in this just being able to play out exactly again. But really, the long and short is I think we're going to have to wait and see. You know, I think it's at this point too early to say that we're guaranteed to go into a protracted bear market. But I think it's also premature to say that, you know, this is just nothing to worry about and that we're just still guaranteed to be in a bull market. I think that we just have to wait and see. I think, unfortunately, with the crypto markets right now, they're too beholden to what's going on in the broader equities markets. And because of the broader macro uncertainty, I think that's going to have to get resolved. Potentially, that's going to have to get resolved before crypto can really start decisively moving to the upside. We're going to have to wait and see. And it could be that once that macro uncertainty resolves and things look bullish again, that we've been able to shake out so many of the weak hands that then crypto could be really set up for a decisive move to the upside. We're just going to have to wait and see. And again, I think the key right now is just thinking about time frame. That, you know, with a long enough time horizon, some of these things just don't look as scary. You know, when you zoom out in the broader moves here, you know, it's not as concerning to think about that. But if you're thinking really short term, that's where it gets a lot more uncertain about where things could be going. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. And we'll just have to wait and see.